If you have money sitting in a savings account right now, there's a good chance you're earning far less interest than you could. And here's the interesting part. You might not need to take more risk to earn more. You may simply need a different type of savings account. That's where the debate between a high-yield savings account, or HYSA, and a traditional savings account comes in. Both are designed to help you keep your money safe and accessible. Both can be used for emergency funds, short-term goals, and cash reserves. And when they're held at an eligible institution, both can have federal deposit insurance within applicable limits. So what's the real difference? Why would someone choose an online HYSA over a savings account at a major bank with branches across the country? And is a HYSA actually better for everyone? In this video, we'll break down the differences in interest rates, accessibility, fees, convenience, and the best way to use each account. By the end, you'll know which option may make more sense for your money. First, what is a traditional savings account? Let's start with the familiar option. A traditional savings account is the type of account many people open at a brick-and-mortar bank or credit union. You can usually walk into a branch, speak with a banker, deposit cash, withdraw money, transfer funds, and get help with your account in person. For many people, that convenience is the biggest advantage. Imagine you run a small business and regularly deal with cash. Being able to walk into a nearby branch and deposit that cash immediately can be extremely convenient. Or maybe you simply prefer talking to a real person when you have a banking problem. A traditional bank can provide that experience. The downside? The interest rate may be very low. And that brings us to one of the biggest differences between traditional savings accounts and HYSAs. What is a high-yield savings account? A high-yield savings account is simply a savings account that typically pays a much higher interest rate than many traditional savings accounts. Many HYSAs are offered by online banks or digital banking divisions. Because these banks generally don't have to maintain large networks of physical branches, their operating costs can be lower. Some of those savings can potentially be passed on to customers through higher interest rates. And this difference can become surprisingly large over time. Let's look at a simple example. Suppose you have $10,000 in savings. If your traditional savings account pays just 0.05% APY, you would earn roughly $5 in interest over 1 year, assuming the rate stayed the same and ignoring compounding for simplicity. Now imagine that same $10,000 earning 4.50% APY. You could earn roughly $450 over a year, assuming the rate stayed at 4.50%. That's a difference of about $4.45, and you didn't invest in stocks. You didn't buy cryptocurrency. You didn't take on additional market risk. You simply earned a higher rate on your cash. Of course, actual APYs change over time, and the exact amount you earn depends on the account, balance, rate changes, and compounding. But the basic idea is simple. The interest rate matters. The biggest difference. APY. When comparing savings accounts, don't just look at the word interest. Look at the APY, or annual percentage yield. APY tells you how much you can earn over a year while taking compounding into account. For example, let's say you have $20,000 sitting in savings. If one account pays 0.05% APY, your annual interest would be very small. But if another account pays 4.5% APY, the difference becomes much more noticeable. And the larger your balance, the more important that difference becomes. This is especially relevant if you're keeping a large emergency fund. Let's say your emergency fund is $30,000. Leaving that money in a very low-yield account could mean giving up hundreds of dollars in potential interest every year. And remember, an emergency fund isn't supposed to be exciting. It's supposed to sit there until you need it. So if you can keep it safe, accessible, and earning more interest, that can be a smart move. But there's a catch with HYSAs now. Here's something important. A high-yield savings account isn't a magic account that permanently pays a high interest rate. HYSA rates are usually variable. That means the bank can change the APY. If the broader interest rate environment changes, the rate on your HYSA may go up or down. So if you see an account advertising a certain APY today, don't assume you'll earn that exact rate forever. This is one reason you should periodically review your savings account. Also, don't choose an account based solely on the highest advertised APY. Look at the entire package. Check whether the institution is FDIC insured or NCUA insured, depending on whether it's a bank or credit union. Review fees. Check transfer policies. Look at customer service. And make sure the account works with the way you actually manage your money. Accessibility. Traditional banks have a major advantage. This is where traditional banks can win. Physical access. Imagine you need to deposit $3,000 in cash. With a traditional bank, you can often walk into a branch and make the deposit. With an online-only HYSA, that may be much more difficult. Some online institutions don't accept cash deposits directly. Instead, you may need to deposit the cash somewhere else and then transfer the money electronically. That extra step can be annoying. Traditional banks can also provide services like in-person customer support, cash deposits, cash withdrawals, cashier's checks, certain notary services, safe deposit boxes at some locations, immediate branch assistance. So if you regularly use these services, completely abandoning your traditional bank may not be practical. HYSAs are built for digital banking. Now let's look at the other side. If you're comfortable doing your banking online, a HYSA can be extremely convenient. You can typically manage your account through a smartphone app or website. You can transfer money between accounts. You can set up recurring transfers. You can monitor your balance. You can deposit checks using mobile check deposit when available. And you can connect your HYSA to your checking account at another bank. For many people, that's more than enough. You don't necessarily need a branch. You just need your phone and an internet connection. What about fees? Fees are another area where you need to compare accounts carefully. Traditional savings accounts may have monthly maintenance fees. For example, a bank could charge a monthly fee unless you maintain a certain minimum balance or meet another requirement, such as receiving qualifying direct deposits. Imagine a $10 monthly maintenance fee. That sounds small, but that's $120 per year. And if your account is only earning a few dollars in interest, the fee can completely wipe out your earnings. Many HYSAs, on the other hand, have no monthly maintenance fee. Some also have no minimum opening deposit. But don't assume every HYSA is fee-free. Always read the account's current fee schedule. Minimum balance requirements. Minimum balance requirements can also differ. A traditional savings account might require you to maintain a certain balance to avoid a monthly fee. For example, you might need to keep $500 or $1,000 in the account. If your balance falls below that amount, you could be charged a fee. Many online savings accounts have fewer requirements. That can make HYSAs attractive if you're starting with a smaller amount of money. But again, the specific rules vary by institution. Always check the account terms before opening it. FDIC and NCUA insurance? Is your money safe? Now let's talk about something extremely important. A savings account isn't safe simply because it's called a savings account. You want to know whether your deposits are covered by federal deposit insurance. For eligible bank deposits, the FDIC generally provides insurance up to applicable legal limits. For eligible deposits at federally insured credit unions, the NCUA provides comparable federal share insurance within applicable limits. The commonly cited limit is $250,000 per depositor per insured institution for each ownership category. But there are important rules around how insurance limits are calculated. So if you have a very large amount of cash, don't assume that simply spreading it across different account numbers at the same institution automatically gives you additional coverage. Check the institution's insurance status and the applicable coverage rules. And this distinction matters because you should never choose a financial institution based only on a high APY. Safety comes first. HYSA versus traditional savings. A simple comparison. Let's make this easy. A traditional savings account generally gives you convenient branch access, easy cash deposits, in-person customer service, potential access to additional branch-based banking services. But the trade-off may be a lower APY and potentially more fees or balance requirements. A high-yield savings account generally gives you a higher APY, online and mobile access, potentially fewer monthly fees, potentially lower minimum balance requirements, but you may have limited or no physical branch access, and cash deposits can be less convenient. So neither account is automatically perfect for everyone. It depends on how you use your money. Here's a real-world example. Let's say Sarah has $15,000. She wants to keep this money safe because it's her emergency fund. She currently has the money in a traditional savings account earning a very low APY. Sarah rarely visits a bank branch. She doesn't deposit cash. She pays her bills electronically. And she already uses mobile banking for almost everything. For Sarah, moving that emergency fund to a competitive HYSA could make sense. Now let's say John also has $15,000. But John owns a cash-heavy business. He regularly deposits cash and needs branch services. For John, having a traditional bank account could be extremely valuable. He could potentially keep his everyday banking relationship at the traditional bank while putting some longer-term cash reserves in a higher-yield account. And that's actually where our next strategy comes in. You don't have to choose just one. This is probably the most important point in this entire video. You don't have to choose between a traditional savings account and a HYSA. You can use both. Think of your money in layers. Your checking account can handle everyday spending and bills. Your traditional savings account can provide convenient access to cash and branch services. And your HYSA can hold money you want to keep safe while earning a more competitive yield. For example, imagine your monthly essential expenses are $4,000. You might keep a portion of your immediately accessible cash at your traditional bank. Then you could keep your larger emergency reserve in a HYSA. So if you eventually build a 6-month emergency fund of $24,000, you might keep some money immediately accessible and the remainder in the HYSA. The exact setup depends on your needs. The goal isn't to make banking complicated. The goal is to give every dollar a job. What about inflation? There's another reason the interest rate matters. Inflation reduces the purchasing power of money over time. If your savings earn almost no interest while prices continue rising, your cash may lose purchasing power in real terms. A higher yield savings account doesn't eliminate inflation risk, and it doesn't guarantee that your savings will always outpace inflation. But earning a competitive rate can help your cash keep up better than leaving a large balance in an account paying almost nothing. That's especially important for money you need to keep in cash anyway. When should you choose a traditional savings account? A traditional savings account may be a better fit if you frequently handle cash. You want easy access to physical branches. You prefer face-to-face customer service. You need branch-based services. You want your savings and checking accounts under one local banking relationship. Or you simply value convenience more than maximizing every dollar of interest. There's nothing wrong with choosing convenience. Personal finance isn't only about getting the highest possible return. It's also about making your financial system easy enough to actually use. When should you choose a HYSA? A HYSA may make more sense if you rarely use physical branches. You manage most of your finances online. You want your emergency fund to earn more interest. You're saving for a short-term goal. You want to avoid unnecessary monthly fees. Or you simply don't want thousands of dollars sitting in a low-yield savings account. The key is to compare the actual APY, fees, insurance coverage, transfer options, and customer experience. What about your emergency fund? For many people, an emergency fund is one of the best places to consider a HYSA. Your emergency fund isn't supposed to be invested aggressively. You need the money to be relatively stable and accessible. A common guideline is to keep around 3 to 6 months of essential living expenses in an emergency fund, although the right amount depends on your income stability, household situation, and expenses. If your essential monthly expenses are $4,000, for example, 3 months would be $12,000. 6 months would be $24,000. Keeping that money in a competitive savings account can allow it to earn interest while remaining relatively accessible. One more important warning. Don't chase an interest rate without reading the fine print. A bank might advertise a very attractive APY, but there could be conditions. Maybe the promotional rate only applies for a limited period. Maybe the rate is only available for a certain balance. Maybe there are account requirements, or maybe the institution isn't federally insured in the way you expected. Before opening an account, verify the current APY and account terms directly with the financial institution. Rates can change, policies can change, and promotional offers can expire. So, which one is better? If you want the simple answer, for earning interest on cash, a competitive HYSA will often be more attractive than a traditional savings account paying a very low APY. But that doesn't mean traditional banks are useless. They offer something an online HYSA may not: physical access and convenience. For many people, the best strategy isn't HYSA versus traditional savings. It's HYSA plus traditional banking. Use the traditional bank for the things it does best. Use the HYSA for cash you want to keep safe while earning a more competitive yield. Final takeaway. Let's recap. A traditional savings account gives you convenience, physical branches, and easy access to cash. A high-yield savings account can potentially give you a much higher APY and fewer fees, but usually with a more digital experience. If you have $10,000 earning almost nothing, moving that money to a competitive savings account could make a meaningful difference over time. But remember, interest rates change, fees matter, insurance matters, accessibility matters, and the best account is the one that fits the way you actually manage your money. So before you leave your savings sitting on autopilot, take a few minutes to check one thing. What APY is your money earning right now? You might be surprised by the answer. And if you're earning almost nothing, it may be time to explore your options. If you found this video useful, hit the like button, subscribe to the channel, and turn on notifications for more simple, practical personal finance videos. And remember, your money should not just sit there. It should have a purpose. Disclaimer. This video is for educational and informational purposes only and should not be considered financial, banking, tax, or investment advice. Interest rates, fees, insurance rules, and account terms can change. Always verify current information directly with the financial institution and consider your own financial situation before making financial decisions.